What's up guys, welcome back to the Daily Stock Picks, and in this video we will be going over 4 stocks that you should consider buying right now, as many of the people are in a lockdown during these uncertain times. The 4 companies that we'll be discussing today have exceptional balance sheets and sound fundamentals, and I'm pretty sure that you guys will agree with me as well right after watching this video. Hi, my name is Rin and I create financial videos like these where I discuss about wonderful companies along with their financials so that you can come to a logical conclusion whether you want to invest in these companies and be a part of them. If you guys feel like being awesome, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. And without further ado, let's get this video started. The first company in this list is Dollar General, ticker symbol DG. Dollar General is a leading American discount retailer which operates over 16,000 stores across 45 states in America, selling branded and private label products across a wide variety of categories. And I think that every investor should consider buying Dollar General, as essential services like sustenance and basic goods are something that every person needs to buy irrespective of the economic situation. And another stock that comes into mind when discussing about Dollar General is Kroger, but I personally think that Dollar General has a wider consumer base. Dollar General is trading at a stock price of $198.55 per share, with a 52-week low of $125 and a 52-week high of $198.91. Looking at the price chart over the past 10 years, we can see that Dollar General has been trending in the upward direction, which is always a positive sign to see for investors who are investing into the company. And comparing to the S&P 500 index, we can see that over the past 10 years, Dollar General has returned nearly 21.93% to shareholders when compared to the S&P 500 index, which only returned 14.30%. In both the cases, the dividend that the companies pays out have been reinvested back into the stock itself. And when coming to its profitability, we can see that Dollar General has a healthy return on invested capital level of 18.13%, which basically means for every $100 that you invest into the company, $18.13 is returned back in terms of pure profits, or profits that the company is able to generate. Looking at the financials, we can see that Dollar General numbers seems to be pretty impressive, with its revenues increasing over the past 10 years along with its free cash flows. To be honest, this might be the smoothest curve linear graph that you can see pertaining to a company, and we can see that the company is currently paying around $327 million as dividends when compared to its free cash flows of $1.453 billion. And if you were to divide $327 million by 1.453, you would get a payout ratio of somewhere around 22%, meaning that the remaining 88% odd can be reinvested back into the business. Looking at the dividend growth history, we can see that the company has been increasing its dividends over the past 5 years at a rate of somewhere around 7.72%, which is a really good sign for all those passive investors out there. Last but not least, we can see that coming to its balance sheet, we can see that Dollar General has a total long-term debt of around $3.96 billion, which can be easily covered by liquidating its current assets, which is around $7 billion, showing that the management is pretty debt conscious and they are managing the debt well for the company in case it does come across any stormy weathers in the coming few months. Dollar General has a market capitalization of $4.49 billion, I would say nearly $50 billion, and the price to earnings ratio is 25.74, which is slightly undervalued when compared to the S&P 500 index. I like to look at what the Wall Street analysts are currently recommending for this stock, where 1 being a strong buy and 5 being a sell, and their ratings are currently at a 2, which means a buy, and the average price target is around $206.20, which is slightly lesser than the current price of $198.55. Looking at numbers like these, no wonder that Dollar General has hit a 52-week high, as many investors are confident about the stock and the company's business model. Hence, it comes highly recommended as one of the recession-proof stocks in many articles across the internet. The second company in this list is Lowe's. companies, ticker symbol LOW. Lowe's is the second largest home improvement retailer in the world, operating around 1,970 stores throughout the United States and Canada. The firm's stores offer products and services for home decorating, maintenance, repair, and remodeling. I personally believe that investors should direct their research on stocks to buy towards key essentials that doesn't exclusively involve nourishment. Rather, it's the little things that we take for granted that generally goes wrong during an emergency or a crisis. And that's where Lowe's companies really shines. Looking at the numbers, Lowe's is currently trading at a stock price of $154.34 per share, with a 52-week low of $60 and a 52-week high of $157.98. Looking at the price chart, we can see that Lowe's price has been consistently increasing over the past 10 years, and it's right now currently trading at that $154.34 that we mentioned about. And if you were to compare this to the S&P 500 index, we can see that Lowe's has produced a return of nearly 25.13% when compared to the S&P 500 index, which is only 14.30%. As similar as below, all of the returns are based on the dividends being reinvested back into the business. And coming to its profitability, we can see that Lowe's currently has a return on invested capital of nearly 20.81%, showing that it is a pretty profitable business and it does seem to have some sort of competitive advantage working in its favor. And looking over the past history, the lowest that I could see that Lowe's has hit was somewhere around 7.53%, not bad for a company of this scale. Looking at its revenue and free cash flow levels over the past 10 years, we can see that Lowe's companies has been increasing in the upward direction, but when compared to the free cash flow, we can see that the company did take a huge hit. Could be because of the current pandemic situation in 2020, and it currently has a free cash flow level of $2.812 billion, B with a billion, and out of which $1.618 billion is being paid out as a dividend, meaning that according to my calculations, this only equates around 56% of its current free cash flow, meaning that the remaining amount of money can be reinvested back into the business in order to increase its bottom line. Looking at the dividend growth history, we can see that the Lowe's has been increasing its dividends over the past 56 years at a rate of 19.39% and belongs to a specific class of dividend paying stocks known as the dividend kings. And when coming to its balance sheet, we can see that it carries a total long-term debt of around $21.80 billion, which can be easily covered by its total current assets, showing that it has no issues managing this long-term debt. But it is a little bit closer to the current assets. I generally do like to see current assets being more than the long-term debt to be on the safer side. But rest assured, its dividend is protected and it does have a large growth potential in the coming days because of the current pandemic situation. Lowe's currently has a market capitalization of $116 billion, approximately $117 billion, with a price to earnings ratio of 26, which is undervalued when compared to the S&P 500 index, which we've seen previously, which was around 28.99, approximated out to 29. So it is undervalued when compared to the rest of the market. The Wall Street analysts are currently rating this company as a 1.8, which is somewhere between a strong buy and a buy, with the average price target of $163.63, which is slightly higher than the current price of $154.34. And my approach to recommending the stock is that during uncertain times, people generally go towards like basic necessities in life, like food, water, and shelter. As several media reports have indicated, we're experiencing a record-breaking hurricane season this year. So yeah, 2020 literally stinks, but you can mitigate some of that pain by buying Lowe's stock. And coming to the third company is Five Below, ticker symbol FIVE. Five Below is a value-oriented retailer that operates nearly 900 stores in the United States as of 2019, catering to teens and preteen consumers. These stores feature a wide variety of merchandise, the vast majority of which is priced at or below $6. Frankly speaking, during these uncertain times, I think it is a lifesaver for many struggling families. Thus, you should feel good about buying FIVE stock and being a part of this company. At the time of this recording, FIVE is currently trading at $110.24 per share with a 52-week low of $47.53 and a 52-week high of $137.97. Coming to the price chart, we can see that the company has been increasing in its stock price over the past 10 years, which is a really positive sign for investors who have invested in this company. And when compared to the S&P 500 index, FIVE has nearly returned 19.30% to its investors over the span of 8 years, because it has only become public from 2012. I would say that the company is pretty profitable, as it has a current return on invested capital amount of 25.47. Anything above a zero shows that the company has a good profitability in its numbers and shows that it does have some sort of long-term competitive advantage when compared to its industry peers. And going back on this chart, the lowest that I could find over the past 10 years was somewhere around 23.90%, meaning that even at its lowest profitability, we can see that the company has above 10%. Which is always a positive sign to see. Looking at its revenue and free cash flow, we can see that the revenue has been trending in the right direction, but the free cash flow did take a plunge. Currently is losing money at around $25.27 million, but prior to the pandemic highs, it was somewhere around 70.41. I think that because of this, the price for FIVE below did take a markdown, but I think that this is the right time to invest in the business because of its future returns that it can provide to the general public or the investors. And it currently does not pay out any dividend, which is a really good decision from the management. And it just needs to improve its bottom line a little bit more so that it becomes more profitable. And the bright side is, even though that the company is bleeding money at the moment, currently has no long-term debt, which is meaning that any financial obligations which it owes to other third parties, and it has a pretty good current asset levels of nearly $500 million in its balance sheet if the management decides to use some of its cash reserves in the coming few months because of the pandemic. FIVE below currently has a market cap of $6.147 billion with a price to earnings ratio of 62.60, which is definitely not a pick for value investors because it does seems to be overvalued when compared to the broader market. Wall Street analysts are currently rating this company at a 1.9, which is a buy with the average price target of $124, which is way lesser than the current price of $110.24 per share. Look, I won't lie, but the stock was down 16% in the first half of 2020 due to FIVE closing down all the locations and furloughed workers. As a result, the free cash flow levels did take a hit, but there is a bright side to this as well. Since April 21st, the company has reopened over 700 of its 900 stores, and also noteworthy is that the company has opened 40 new locations so far in 2020 and are in a pace to open up 100 to 120 new stores despite the current economic downturn. The fourth and final company in this list is Robert Half International, ticker symbol RHI. RHI was founded in 1948, which is a pretty old company, and it provides temporary, permanent, and project-based staffing to corporations seeking employees in the finance, accounting, and technology. It is one of the largest global staffing firms operating hundreds of locations in several countries. I get it, RHI is not a younger company like Fiverr, which is a startup, but I personally think that RHI, an established brand, reputed company, offers a unique advantages during this pandemic that its rivals can't match. For the past 2 months, we can see that Donald Trump going on and on raving about the record-breaking job reports for May and June despite of the current pandemic situation. Technically, he's right. But we're just talking about percentage gains across extremely deflated comparisons. Presently, the unemployment rate is 11.1%, which is totally bananas, and it is a terrible number to look at. When everything is chaotic, many folks want to measure stability. RHI provides that, and it's not old to learn new tricks. For instance, the company lists many work from home opportunities, reflecting its adaptability to these uncertain times. RHI is currently trading at a stock price of $56.63 with the 52 low of $32.38 and a 52-week high of $63.84. Looking at the 10 years price chart, we can see that the stock has been appreciating over the past 10 years. RHI didn't perform that well when compared to the S&P 500 index, where it only returned 11.27% when compared to the S&P 500 index of 14.30% in the same 10-year interval. Looking at its core business, we can see that the revenue and the free cash flows have been increasing in the right direction over the past 10 years, and it currently has a free cash flow levels of $460 million, out of which $145 million is being paid out as a dividend. And according to my calculations, this equates to around 32% of the free cash flows. Looking at the dividend history, we can see that the company has been increasing its dividends over the past 15 years at a rate of nearly 10%, which is pretty good for all those income investors out there who like to invest in dividend paying stocks. Currently, RHI has a market cap of $6.5 billion and the price to earnings ratio of 17.71, which is super undervalued when compared to the S&P 500 index, which is around 29. Wall Street analysts are currently recommending this stock as a 3, which is a hold, and their average price target is $50.17, which is slightly lesser than the current price of $56.63. And coming to the news, as of July 30th, RHI has announced its quarterly dividend increase, and a cherry on top, many analysts are really positive and expecting to beat their estimates in the coming quarters of this year. That's it, guys. These are the 4 companies that really look promising when I did my stock market research. And if you guys like any one of these companies, make sure that you comment down below which company that you're going to do more research in before investing your money. So if you guys have stuck around till the end of the video, I really appreciate it, and catch you in the next video. Peace.